Fed Chair Powell finally giving the market what it had been clamoring for on Friday, a pivot. Let's talk about that now with Mohamed El-Erian, who joins us. He's, of course, the Chief Economic Advisor at Allianz and President of Queen's College, Cambridge. Mohamed, great to see you. We've switched countries this week. Obviously, you've written about this in the FT today, and it's a great read. I recommend people have a look. But you're actually quite critical of Jay Powell in the article you've put out this morning.
I am. Let's just start with what was timely, if not a little bit late, which is a recognition, a la Chris Waller, that the risks to the employment side of the mandates are higher. And while there's inflation risks, he downplayed the second and third round effects of tariffs. I think that is correct, and I'm glad he did that. The market repriced, of course, September cut to 85%, and the remaining 15% is between nothing and 50 basis points. We have to remember that. But what next? He didn't give much clarity on what happens after September. And then he said almost nothing about the policy implications of all the structural changes that he mentioned in the labor force, in the trading system, in the operation of the domestic economy. And that matters, because it matters for key issues of monetary policy, the level of interest rates, the equilibrium level of interest rates, the equilibrium level of the balance sheet. And it also matters for the framework. The last thing we want is a framework that once again is dead on arrival, or like the Wall Street Journal characterized the 2020, which was the most poorly timed change in the monetary framework. So I'm glad for what he said, but I'm disappointed for what he did not cover.
And I guess your point is that the Jackson Hole is typically a place where you would expect or hope to see some of those broader, longer-term topics covered. One other thing that you raise in the op-ed as well is this point that's been discussed a lot about what the long-term inflation target should be. Do you think it should be 3%? Do you think it will be 3%? And what would that mean for equity markets and other assets if indeed that shift one day formally took place?
So first of all, Jackson Hole is the place to do it. This was his last Jackson Hole. He's had 8 of them. You would have expected him to talk about lesson learned. You would expect of him to keep to strategy issues, but he didn't. And that's because his tendency is to be data dependent, not strategic. In terms of the employment target, look, we're running an employment target around 2% de facto. For 4 years now, we've been above 2%. We don't get back to 2% for another 2 years, according to the Fed. So de facto, we're running with a higher inflation target. Now, they ruled out any discussion of this in the framework, but I can tell you that behind closed doors, people are asking the question, is a better inflation rate 2.5% to 3% than 2%? And the reason is, again, the structural changes. And he's acknowledged by putting the risk on the employment side at a time when inflation is still going up, he has somewhat acknowledged that for now, the 2% inflation target is not as applicable as it has been in the past.
But it doesn't appear, Mohamed, that the bond market seems that they've lost any kind of credibility as inflation fighters as a result of the comments on Friday, right?
So look at the long end. I've been absolutely fascinated by what's been happening to the long end of curves. And not just in the US, around the world. Last year, Japan hit its highest level. The UK is at its highest level in many decades. The reaction of the long end here, the 30-year, was very muted compared to what it was before. You saw in the chart, we basically back at where we were on Friday morning, within 1 or 2 basis points for the 30-year. I think what the long end is recognizing is this notion of fiscal dominance, that we've entered a period of high deficits, high debt, and that monetary policy for now is going to be impacted by what's happening elsewhere in the economy. And I think that is what you're seeing in the long end, and that explains the 230s of 120 basis points.
In terms of long-end rates, do you think that US long-end rates can be dragged higher if there's a big fallout in Japan or a big fallout in the UK, for example, or not?
To some extent. It's much bigger the other way around. If you have a big fallout in the US, that will pull the rest of the world up. we get pulled out to some extent. To give you a sense, the beta for us to the rest of the world. So if the US goes up to the 30-year, the beta elsewhere is near 1. In the case of the UK, as you know, Wilfred, it's above 1. However, if the rest of the world goes up and we react, our beta is below half.
Hey, Mohamed, I wanted to pivot just to a wild other conversation, given that we've gone over where this market may go. We've been talking all morning about Intel. You're in London right now, or the UK, I should say. Do you have a take on what we talked to Kevin Hassett earlier. He basically said pretty flat out, the U.S. government's going to not just take stakes in things like Intel, but we're going to have a sovereign wealth fund that's going to be taking stakes in all sorts of businesses in the United States, it sounds like. What do you make of that?
So I'm getting nervous at this notion that this is beyond Intel. The only thing I like about this Intel transaction is a message to the private sector: there is no free lunch. If you're going to take money from the government, don't think it comes free. However, I worry about two things. I worry about the spreading, and I worry about the lack of respect in this critical difference between ownership and control. Ownership is fine. Starting to impact business decision is really problematic, as Kevin said. What distinguishes the U.S. from the rest of the world is a dynamic entrepreneurial private sector that reacts quickly. And I just would be very nervous if suddenly we go into a world in which the government starts impacting lots of business decisions.
Okay, but do you think there's a difference between taking non-voting stakes in businesses and basically taking non-voting stakes in businesses and maybe trying to influence things around the edges, right? I mean, that's what we're talking about here. There was a piece over the weekend in the New York Times that called Donald Trump the new activist CEO, the ultimate activist CEO.
Yeah, and I go back. It's between ownership and control. If they want to have ownership, if a sovereign wealth fund wants to have a stake in corporate U.S., okay, that's fine. But please don't go anywhere. Control, business decision, influences. That is a very slippery slope. Countries have gone down that slope, and it ends up by undermining the economic outlook and prosperity.